Hi, this is Brett Chappell, and welcome to Fixed Income Perspectives. With me today is Kevin McPartland from Coalition Greenwich.
Hey, Brett, thanks so much for having me. Look forward to speaking.
Yeah, I hope you're keeping nice and warm here, even though it says sunny behind me. It's rather, really cold. We've got a bit of a blizzard going on. But I want to just jump right into it. You have recently come out with a new publication talking about the U.S. market and e-trading. This is really fascinating for a lot of the people in Europe as we're seeing what's happening over on the other side of the pond. Can you break it down a little bit with some quick takeaways?
Yeah, the US market had another really strong year, focusing in on US corporate bonds specifically. The average daily notional volume was up 11% year over year. That's the fourth year in a row volumes have grown. Uh,
Wow.
the average was about 51 billion notional bonds traded a day. It's the first time the full year average was over 50 billion. So that's pretty impressive growth in the span of just a couple of years. New issuance was a big part of that for sure. It was a record year for new issuance in the U.S. and there's a lot of macroeconomic reasons that we won't get into now. But new issuance certainly helps secondary market turnover. But we can't, of course, ignore the effects of e-trading here as well. So while the percentage of notional volume handled by electronic channels came through roughly flat in 2025 compared to the year before at about 44%. It's important to remember, right, that the total market volumes, like I just said, were up 11%. So e-trading really kept pace. And if you look at the notionals, you see that it was high yield that actually led the way. So
Okay.
e-trading in IG was up 11%, sort of tracking the market, whereas for high yield, it was up 18% as we saw some real strength in the fourth quarter.
I mean, those are impressive figures. And I know that it's primarily dominated by a handful of main players. But what about the arrival of the non-bank, the non-financial institutions? We're talking like the Jane Streets of the world. How are they coming in?
Yeah, I mean, I would say we're long past their arrival. They've been here a long time. They're a very solid part of the market. I think,
Mhm.
portfolio trading in particular has been an area of strength for the few that are there. I think we can't paint them all with the same brush, right? The models of those firms can be very different. Some more investment banking like, some more prop trading like, and really everything in between. The number of firms that are doing sizable volume and client facing is relatively small. Although the liquidity that those firms provide in U.S. corporates, and then more broadly, whether it be in the ETFs, growing story in credit futures in the States, or then especially if we get into markets like treasuries, the role is even bigger.
I think you mentioned a few things. ETFs obviously are huge. They're starting to take off over here in Europe. You're talking about the credit futures. I'd be just curious to know, what do you think are some of the movers and shakers that we're going to see in the course of 2026?
Yeah, so ETFs is always a story, although I'll say, interesting points from the data looking at 2025 is we measure the trading volume in credit ETFs relative to trading in the bond market. It was
Okay.
actually down slightly, so the volume in ETF trading was a little bit lower, relatively speaking, to what happened in the underlying bond market. Still a very strong and growing retail product, there's no doubt. But from a trading perspective, I think, the reason why we're seeing a little bit of a leveling out there is the liquidity that's built up in investment grade US corporates in particular, and the availability of portfolio trading and the liquidity that can be found there. You have portfolio managers who might have otherwise used ETFs to put some exposure on. Now they're just trading the underlying bonds, right? So really
Yeah.
interesting. So we shouldn't underplay how important ETFs are to the market. But then on the other hand, as the bond market gets more liquid, there can be cases where those fund managers, yeah, just go to the bond market and sort of leave the ETFs aside.
I think we're seeing a little bit of that where people are switching out of dollar assets and moving into euros, and instead of doing the ETFs, they're doing the individuals. But in terms of just maybe to conclude really quickly, what do you think is maybe one main takeaway that we should enter into 2026 after doing your analysis of the US market from a credit perspective?
Sure. I think from talking to quite a number of buy side traders in the fourth quarter, the expectation that the volume growth will continue. This is structural, not cyclical. There are, of course, always cyclical elements to the bond market based on global economics and interest rates, but long term, the structural shift is towards more volume for sure. I think the other thing that really kind of showed itself in 2025 and will certainly continue into 2026 is the level of competition amongst the trading venues is increasingly fierce. There are some really impressive tools that have been built. And it used to be the only story was could you build a big enough pool of liquidity? That is still true. That is still a superpower for those that have it. However, especially for things like portfolio trading, where you don't need hundreds of dealers, you probably need only a few. The tools and the analytics can be as much of a driver there as the depth of liquidity on that platform. So the competition here is just incredible, and that is, ultimately really, really good for the end investor.
I agree with that, and I think all's fair in love, war, and venue internecine warfare, I guess. Listen, thank you so much, Kevin. Appreciate you taking the time, and look forward to catching up during the course of 26 and exchanging notes. Thank you so much.
Likewise, Brett. Thank you.